Welcome back to the deep dive. Today, we're taking on a topic that sits right at the intersection of your brain and your bank account.
Hmm.
We're pulling together research from, the world of behavioral finance, neuroeconomics, and psychology to tackle what is probably the single greatest yet least discussed threat to your long-term financial health.
It's a strange one because when most people think about financial catastrophe, they picture something dramatic.
Right, a stock market crash.
Exactly.
Mm.
They see a graph with a sharp, terrifying drop the market crash,
Mm-hmm.
hyperinflation, some kind of, massive external shock.
And those events are loud. They capture all the headlines.
They do, and they trigger this immediate acute panic.
Mm-hmm.
But the data shows they are rarely the primary cause of personal wealth destruction.
Exactly. So our mission today is to dive into what we're calling the silent hemorrhage.
Mm-hmm.
The idea that the most corrosive force acting on your financial future isn't some big external event that happens to you. It's the constant, internal, quiet leakage caused by our own ancient and frankly maladaptive fears.
It's a fundamental mismatch. We're exploring how the human operating system, which is still, optimized for surviving immediate threats on the savannah, systematically self-sabotages wealth accumulation in the abstract modern world of compounding interest in 401k.
These internal fears, the fear of scarcity, the fear of loss, the fear of social insignificance, they don't manifest as your portfolio going to zero overnight.
No, it's much quieter than that.
They manifest as these subtle, persistent behavioral patterns and cognitive biases that just chew away at your capital base year after year, often without you even realizing the damage until it's way too late.
It's the cost of waiting. It's the cost of panic selling, the cost of unnecessary lifestyle inflation.
All driven by fear, not math.
Yeah.
At the end of the day, yes.
So let's unpack this. We've broken this deep dive into 3 core areas of exploration. First, the biology, which is fascinating. The neurobiology of scarcity, what researchers call the IQ tax.
Right.
Second, the quantifiable cost, the mathematical devastation of loss aversion, which creates something called the behavior gap.
A huge one. And finally, the psychological deep roots. How our childhood and our social anxieties drive these destructive money scripts. So let's jump in.
Okay, so to really understand why we make poor financial decisions, we have to start with this fundamental biological mismatch.
Right.
Our brains they're masterpieces of efficiency for hunting, gathering, and immediate resource protection. They're just absolutely terrible at dealing with abstract concepts like diversified mutual funds or 30-year mortgages.
Or future inflation rates, things that are, decades away.
Exactly. And the most profound biological trap we fall into is what's known as the scarcity mindset.
And this isn't just a clinical term for being poor, is it? It's a literal neurological state.
That is the crucial distinction. Scarcity, as defined by researchers like maladaptive and Shafir, is the perception of having less than you need.
Regardless of your actual wealth.
Regardless of your absolute wealth. It's a mindset that fundamentally alters your information processing. It could be you struggling to make rent, or it could be a millionaire who feels their portfolio isn't growing fast enough compared to their peers. When that scarcity signal hits, the brain involuntarily captures all of your available attention and just locks it onto the immediate lack.
That sounds exhausting. It's like having an emergency alarm just stuck on perpetually in the background.
It is, and that constant background alarm requires computational power. This is the whole concept of mental bandwidth.
Okay.
Think of your mental bandwidth as the finite processing capacity you have for attention, for executive functions, long-term planning, and impulse control.
Your brain's RAM, essentially.
A perfect analogy.
Yeah.
And when you are financially worried, that relentless internal monologue, how will I pay that bill? Do I have enough? It just consumes that bandwidth.
So the financial worry itself imposes a cognitive load. What is the real-world cost of that constant, low-level financial noise on our daily function?
The cost is measurable and, frankly, shocking. It imposes what they term the IQ tax.
IQ tax.
Researchers found that the sheer cognitive burden of financial worry is equivalent to experiencing a significant drop in what we call fluid intelligence.
And fluid intelligence is your ability to reason and solve new problems, right? Not just what you've memorized.
Exactly. It's your active problem-solving horsepower.
You have to detail the India farmer study here because this is the landmark evidence that, it proves this isn't just a theory.
This research is so compelling because it uses the same people as their own control group. It's elegant.
Right.
So Mullainathan and Shafir studied sugarcane farmers in Tamil Nadu, India. Now, these farmers are paid in one large lump sum after the harvest.
Okay, so they have a very distinct cycle of being poor and then rich.
A very predictable one. For the months leading up to the harvest, they are cash poor. They're relying on credit. They're deeply stressed about money. And then, immediately after the harvest, they are suddenly cash rich and financially secure.
And they tested them during both states.
Precisely. They administered standard cognitive tests, like Raven's progressive matrices, which measure that fluid intelligence we talked about. It's about problem-solving ability, not education level.
So what happened?
Before the harvest, when the farmers were burdened by that financial scarcity, their performance on these tasks dropped dramatically.
Yeah.
After the harvest, when they were cash rich, their performance rebounded.
And the quantifiable difference in their cognitive capacity was what?
It was equivalent to a 13-point drop in IQ.
13 points. That's huge.
Think about that. That's the difference between a normal IQ and one that's significantly below average. It is the same person, physically identical, yet the cognitive burden of scarcity essentially taxed their brain power to the level of someone who has lost an entire night of sleep.
Wow.
And this changes the narrative completely. It suggests that poor planning under financial stress is often a mechanical result of an overtaxed brain, not some kind of fundamental personal flaw or character defect.
It reframes so many financial mistakes as resource management failures, not character failures. And this scarcity tax, it leads directly to a kind of hyperfocus that is also, maladaptive, the tunneling phenomenon.
Yes, when your bandwidth is consumed, your brain desperately tries to cope by tunneling.
So it narrows its focus.
It hyper-focuses intensely on the immediate urgent need to the exclusion of literally everything outside that narrow tunnel. If a lion is chasing you, tunneling is great. It means you don't worry about where you left your keys.
But in modern finance, it's a disaster.
It is. So while you might be incredibly productive at securing the exact amount you need for a specific urgent bill, you miss the entire bigger picture.
And that's the tunneling tax.
That's the tax. Crucial, long-term, non-urgent tasks are completely neglected. Things like diversifying your investments or negotiating a better interest rate or even just reading the fine print on a loan.
This explains the predatory payday loan example perfectly.
It's so tragic, and it's not about intelligence. The individual is not stupid. They are in a state of cognitive depletion. They see the $500 they need right now as the only reality.
Right.
The 400% annual interest rate, the long-term devastation, it falls completely outside the tunnel's vision. It's abstract future pain versus concrete immediate relief.
And the brain, under what it perceives as a survival threat, is always going to choose immediate relief.
Every single time. It's optimized for extinguishing the immediate fire, even if that means lighting a far bigger one later.
And the neuroeconomics research, it actually backs this up with brain scans, right? It shows a physical shift that creates this present bias.
Yes, fMRI data illuminates the mechanism. It's fascinating. When subjects are financially stressed or primed with scarcity scenarios, activity measurably decreases in the dorsolateral prefrontal cortex, the DLPFC.
Which is the sophisticated, rational part of the brain, the CEO.
The CEO, exactly. It's responsible for high-level working memory and long-term goal planning. So the long-term planner is literally shutting down.
It's going offline.
It is. And at the same time, activity often increases in the amygdala, which is the fear center, and the orbitofrontal cortex, which processes immediate rewards.
So the emotional short-term brain takes over.
That chemical and electrical shift forces the brain into what's called hyperbolic discounting, a strong preference for smaller, immediate rewards over larger, delayed ones.
So if you get a small windfall, your brain just wants to spend it now.
It treats it as immediate survival currency. It pushes you to spend it now for that momentary relief, rather than investing it for a more robust future. It's the brain prioritizing the perceived survival need of the present over the abstract well-being of the future.
So we've established this cognitive tax that financial worry imposes. Let's move to the raw physiology, because fear doesn't just change how we think. It changes how our body physically responds.
Absolutely.
And those physical responses are what drive these reactive, destructive decisions.
Chronic financial stress means your body is constantly running a chemical marathon. The HPA axis, the hypothalamic pituitary adrenal axis, is continuously triggered.
So it's always on high alert.
It's maintaining what is known as high allostatic load. It's just pumping out stress hormones like cortisol and adrenaline. Your body is perpetually ready for a physical threat that never actually arrives.
And that leads to two very specific and very damaging financial behaviors. the freeze response and the flight response.
Yes.
I think the freeze response, what you might call financial avoidance, is the true silent killer for a lot of people. It's not loud like a panic sale. It's this quiet, pervasive decay.
It is, I think, the most common maladaptive response to debt or overwhelming financial complexity.
Hmm.
When you're facing a perceived threat, like a mounting pile of bills or an ominous-looking bank statement, the body's primal instinct can be to just freeze. You hope the threat will ignore you.
And in finance, this translates to avoidance behavior.
Exactly.
Yeah.
The individual stops opening their mail, they ignore emails from their brokerage, or they simply refuse to look at their balance. They just don't want to know.
They're essentially regulating their emotional state by sacrificing their future security. They prevent that immediate cortisol spike.
Precisely. They are achieving an immediate and very profound reduction in anxiety. But the consequences are devastating and they compound. They incur late fees, they destroy their credit score, they miss crucial deadlines for tax-advantaged accounts.
And they forego compound growth opportunities, the biggest one of all.
Right. The fear becomes phobic, the sight of the envelope itself is the stimulus, and the avoidance is the immediate relief. They are living in this short-term emotional bubble, sacrificing decades of potential wealth growth just to feel okay today.
Now let's contrast that paralyzing freeze with the acute loud stress of fight or flight, which usually comes out during, say, market volatility.
So acute stress like watching your investment account drop 15% in a week, that immediately triggers the amygdala, the central hub for fear processing.
And the rational brain, the prefrontal cortex, gets sidelined.
It's momentarily inhibited, yes. And the immediate biological imperative in this situation is flight. Flee the danger.
And in the investment world, fleeing the danger means one thing:
It means selling your assets.
selling low.
It does. This impulse to reduce the immediate acute pain of watching the numbers drop forces the investor to sell low, converting what were temporary paper losses, which would have inevitably recovered, into a permanent destruction of capital.
And the media language just pours gasoline on this fire.
Oh, absolutely.
Yeah.
The fear is dramatically amplified by terms like bloodbath, wipeout, or plummet. Those words are chosen specifically because they trigger this biological imperative to run for the hills.
So the investor truly believes they're being prudent.
They think they're preventing further disaster, but they are simply executing an ancient fear-based reaction that all but guarantees their long-term financial insecurity. So if the scarcity mindset is the kind of cognitive context for poor decisions, then loss aversion is the mathematical mechanism that ensures they are maximally damaging.
This is a big one.
This concept, which is central to prospect theory from Daniel Kahneman and Amos Tversky, is the silent force that just crushes long-term compounding.
The core finding here, the asymmetry of pain, is what makes us so fundamentally irrational when we're dealing with money.
The asymmetry is potent. The psychological pain you experience from losing a specific sum of money is roughly twice as intense as the pleasure you derive from gaining the exact same sum.
So finding $1,000 feels good, but losing $1,000 feels catastrophic.
Catastrophic, exactly. That 2-to-1 ratio fundamentally dictates our financial behavior. We are hardwired to avoid loss, even if that avoidance means sacrificing a much greater potential gain.
So if an investment has a 50-50 chance of making $10,000 or losing $10,000, mathematically you should be indifferent. But psychologically,
it feels like a terrible deal. It feels like an unbearable risk because the potential pain of the loss just completely outweighs the potential pleasure of the gain in your mind.
And this hardwired aversion translates directly into how people build their portfolios.
It does. Since equities are inherently volatile, they have frequent temporary declines. The loss-averse brain interprets every correction as an existential threat. This causes people to choose overly conservative allocations.
So, too much cash. Too many low-yielding bonds.
Exactly. They overinvest in these guaranteed, stable assets, and in doing so, they are trading away their future purchasing power for today's emotional comfort.
And this isn't just abstract psychology. We can quantify the financial cost of this emotional reactivity perfectly through the Dalbar data, which isolates what they call the behavior gap.
Yes, the Dalbar quantitative analysis of investor behavior is a devastating, and I mean devastating, annual look at investor returns.
So the behavior gap is the difference between what the market returns and what the average person actually gets.
Precisely. It's the difference between the return of a major market index, say the S&P 500, and the actual return achieved by the average investor who is holding funds that track that index. The disparity is entirely due to emotional timing.
Okay, let's get granular on the numbers because this is where the silent hemorrhage becomes really concrete. What does that emotional instability cost people over, say, 2 decades?
Over a 20-year span, the S&P 500 might generate an average annualized return of, let's say, 10%. However, the average equity investor often only captures about 5.5 to 6.0%.
That's a huge gap.
It is, and let's look at the compounding cost of that difference. If you start with a $100,000 investment and let the S&P 500 run at 10%, you have a massive final portfolio. The behavior gap, the difference created by fear-driven selling, market timing mistakes, and chasing performance.
Buying high, selling low.
The classic mistake. On that $100,000 starting investment, it resulted in a loss of potential growth, totaling an astonishing $380,970.
Wow. Nearly $400,000 destroyed purely by acting on the pain of loss and the fear of regret.
The volatility didn't destroy the capital. The fear of volatility destroyed the capital.
That is just staggering.
That cost represents 66% of the potential gains that should have accrued. The investor allowed that biological imperative to flee the immediate pain to permanently cement what were just transient paper losses.
And the modern world, specifically our smartphones, has made this loss aversion so much worse through what's called myopic loss aversion.
That's a powerful modern trap. Myopic loss aversion is basically loss aversion on steroids, exacerbated by the frequency of portfolio monitoring.
Because we can check our brokerage app 100 times a day.
And an investor who does that is constantly exposed to volatility. Since the market is down approximately 50% of all trading days, they're constantly subjecting themselves to these micro losses, triggering that 2-to-1 pain ratio over and over and over again.
So checking it daily dramatically increases the perceived risk of the asset, even if the long-term fundamentals haven't changed at all.
Absolutely. The investor who checks daily sees this jerky, volatile line that causes acute pain, and it pushes them toward a conservative, low-growth strategy. The investor who checks annually sees a smoother, generally upward-sloping line and is much more comfortable riding out the long-term trend.
So deleting the brokerage app might be one of the best first steps.
It often is. It insulates you from the emotional damage of the daily dips.
And where do these terrified investors usually retreat to? They retreat to cash, which leads directly to the problem of cash drag.
Cash drag is the opportunity cost imposed by holding excessive amounts of cash, often because the investor is waiting for the perfect time to buy, or simply because they fear the volatility of the market.
Cash feels safe.
It feels safe because its nominal value doesn't fluctuate. It removes that immediate pain of loss.
But the research on the cost of waiting shows that this perceived safety is actually the ultimate long-term risk.
It is catastrophic to long-term compounding. If you look at the volatility of the stock market, you'll see that the best days often immediately follow the worst days.
Right after a big crash.
Exactly. And the analysis demonstrates that if an investor misses just the 10 best trading days in the market over a multi-decade period, their total cumulative returns can be cut by more than 50%.
So by sitting on the sidelines in cash?
By sitting out, by allowing cash drag to persist, driven by the fear of buying at the wrong time, they guarantee they miss the massive rebound days that define long-term wealth creation. The accumulation of cash drag is the continuous, silent erosion of opportunity.
Okay, we've spent time on volatility, which is the loud, stary risk that triggers the amygdala. But now we have to talk about the silent risk that the brain completely ignores, inflation.
This is where the true illusion of safety lies.
Yeah.
Volatility is the risk you feel. Inflation is the risk you don't feel, but it is mathematically guaranteed to destroy your capital if you hide in so-called stable assets.
It's the silent hemorrhage?
It is, because it works without triggering any of our internal alarm systems. A 20% market crash is a full-blown crisis, a 3% annual erosion of your purchasing power. That feels like stability and comfort.
And this relies on the nominal versus real paradox, which finance professionals sometimes call the money illusion.
The money illusion is the tendency for us, for humans, to focus exclusively on nominal figures, the dollar amount printed on the statement, rather than real terms, which is the actual purchasing power of those dollars.
So if your bank account balance goes up from $100,000 to $101,000 because of interest, your brain registers a gain.
It does. It generates a positive chemical response. You feel good.
Even if inflation was 3% that year, meaning in real terms, you just lost 2%.
Exactly. The amygdala registers zero threat because the number never went down. The illusion of safety is maintained, but the mathematical destruction is relentless. Your money is decaying in value, slowly but surely, while you feel completely secure.
Let's put a concrete number on this destruction of cash. for that risk-averse individual who prioritizes stability over growth.
This is the shock fact that should dispel the notion of cash as a safe long-term asset for good.
Okay.
Consider the person who, terrified of the 2008 crash, decided to keep $100,000 in cash, let's say since 1990. Factoring in inflation, that $100,000 today in real purchasing power is worth only about $43,000.
Oh.
That is a 57% real loss of wealth, and the owner never saw a single red day on a statement.
The fear of a possible short-term loss led to a guaranteed massive long-term loss.
That is the guaranteed atrophy caused by prioritizing stability. And if we look at the ultimate comparison, the S&P 500 versus cash over the extremely long run, the fear premium looks absolutely indefensible.
This highlights the difference between actual risk and perceived risk.
It does. Take a single dollar invested back in 1926. If that dollar was invested in the volatile S&P 500 by 2020 through all the crashes and wars and everything else, it grew to over $10,000.
Okay. And that same dollar in cash or treasury bills.
If that same dollar was held in treasury bills, the gold standard of fixed safe income, it grew to only about $22.
$22 versus $10,000. That magnitude of difference shows the cost of letting fear anchor you to these low-growth assets.
It's the ultimate cost of fear. While equities are characterized by high volatility in the short term, that volatility cancels out over decades, guaranteeing long-term growth that dramatically outpaces inflation.
Whereas cash offers short-term stability.
That stability guarantees the silent hemorrhaging of your capital and purchasing power. The risk of holding cash is simply the certainty of becoming poorer over time. So we've covered the biology and the math of wealth destruction. Now we have to shift to the personal history that makes each of us susceptible to specific fears.
Right, our own stories.
We're talking about money scripts, a framework developed by the financial psychologist Dr. Brad Klontz.
These scripts are the unconscious rules we absorbed about money, often when we were children, and, we lacked the cognitive tools to contextualize financial events.
Precisely. They are deep, often irrational beliefs formed during emotionally charged moments. He calls them financial flashpoints.
A flashpoint could be anything, I imagine.
It might be watching your parents lose their home or the memory of them fighting viciously over a credit card bill. The child, witnessing this high-stress event, internalizes a rule, a script about how dangerous or powerful or shameful money is.
And these scripts then drive self-sabotaging behavior for decades.
For a lifetime, often.
Let's look at the 4 major destructive scripts, starting with money avoidance.
The avoidance script is rooted in the field of moral corruption or social rejection. The beliefs are usually things like money is evil or rich people are greedy and dishonest.
The subconscious driver is identity protection, then.
Exactly. They fear that accumulating wealth will make them a bad person or separate them from their values or their family of origin. And the self-sabotage is chronic. They'll ignore tax documents, unconsciously give away funds through poor investment choices, or simply refuse promotions that would disrupt their identity as a good, non-materialistic person.
That's a deeply ingrained fear of success. Now, for the inverse, money worship.
Worship is fueled by the fear of internal inadequacy or emptiness. The core belief is the if-only fallacy. If only I had X amount of money, all my problems would disappear and I would finally be happy.
This script drives workaholism, a relentless pursuit of the next goalpost.
And compulsive spending, because they're constantly trying to buy internal fulfillment.
But because of hedonic adaptation, the satisfaction fades almost immediately.
Right, so they constantly have to escalate their spending, trying to maintain that brief high. They often end up in higher debt than the average person because they're using money as a drug, constantly chasing a dose of satisfaction that money simply cannot provide. They are paradoxically impoverished by their endless pursuit of financial riches.
Next, money status. This is the one we see played out most visibly in our society.
Money status is driven by the fear of insignificance, the belief that my self-worth is equal to my net worth.
So it's all about external validation.
These individuals are hyper-focused on competitive consumption. They must signal success to others. This means they are buying the new luxury car, often leased, the massive, slightly too expensive home, and designer goods purely for that external validation. They're willing to, they deny themselves necessary healthcare, travel, or experiences. They are financially rich, but experientially poor.
So these scripts explain why the same external financial challenge can cause 4 wildly different internal sabotages. And this gets passed down through intergenerational trauma, creating that famous shirt sleeves to shirt sleeves in 3 generations curse.
We tend to blame legal structures or a lack of planning for that curse, but it is fundamentally a failure of emotional intelligence and the transmission of these destructive scripts.
So the first generation struggles and develops vigilance.
Exactly. They create the wealth. The second generation, raised with that wealth but without the context of the struggle, often shifts to money status. They feel they must prove they deserve the wealth.
And the third generation.
Raised in total, unquestioned abundance, may develop extreme avoidance or unchecked worship because money holds no real emotional meaning or perceived utility for them. This leads to the rapid dissolution of capital. The key disruptor of this cycle is open, honest financial discussion. Otherwise, silence just guarantees the trauma is passed on.
We established that status anxiety, the fear of occupying too low a social rung, fuels the money status script. But let's discuss how this fear works in the broader social context to drain wealth. It's what drives lifestyle creep.
Lifestyle creep is this subtle process where your spending rises in lockstep with your income, which guarantees that you never really get ahead.
And it's driven entirely by social comparison.
Entirely. When you get that big promotion, your income goes up. But the crucial change is that your reference group changes. You stop comparing your car to your old college roommate's car and start comparing it to your new, wealthier senior colleague's car.
And once you buy that new car or that bigger house, the joy is fleeting, which leads to the hedonic treadmill.
The treadmill is the psychological mechanism that guarantees this cycle just repeats itself. The happiness you get from a new material possession, that initial status boost, is very quickly normalized by your brain.
So to maintain that same level of psychological satisfaction, you have to constantly increase your spending.
You're required to constantly increase your spending and consumption. It's an unsustainable race. Competitive consumption is the perfect externalization of this fear. Constantly spending money you need for tomorrow, to buy things you don't really want, to maintain a status that only temporarily placates your deep-seated fear of inadequacy.
And if we look at social media today, the scale of this inadequacy is it's astronomical. The Joneses are no longer just your neighbors.
Precisely. Social media has weaponized status anxiety. Instead of comparing yourself to the 5 families on your street, you are comparing your messy, real-life financial situation to the curated highlight reels of thousands of global influencers, peers, and aspirational billionaires.
Which creates a constant, chronic sense of inadequacy and financial urgency.
And that fuels a specific and very modern behavioral trap. Financial FOMO.
Financial FOMO, the fear of missing out, is the driver behind almost every speculative bubble the last few years.
It is a profound manifestation of status anxiety and the fear of regret. When people see others making easy, rapid gains in speculative assets, whether it's the dot-com bubble, meme stocks, or high-flying crypto, the fear of being the one left behind becomes psychologically unbearable.
That anticipated pain of regret of watching a friend get rich while you missed out, it overrides rational calculation.
It overrides every rational calculation about valuation or risk management. It pushes people into herd behavior, causing them to buy at the absolute peak, chasing the disappearing status that the quick wealth promised.
So if the fear of missing out and status anxiety are the default setting, how do we introduce intentionality to combat this mindless lifestyle creep?
The antidote is the concept of money dials, which was popularized by the financial guru Ramit Sethi. It recognizes that lifestyle creep is probably inevitable, but it should be channeled.
So you direct it.
You direct it. Instead of letting your spending rise across all categories due to social pressure, you must consciously identify the 2 or 3 areas you genuinely value extravagantly. Your dials. For example, high-quality food, convenience, and travel.
And then what about the other dials?
You turn them down ruthlessly. You cut costs on non-valued areas, such as clothing or cable bills or perhaps leasing a car, freeing up those resources. This allows for focused, guilt-free spending that genuinely increases your psychological satisfaction while redirecting maximum capital towards long-term wealth building.
It removes the fear that you have to participate in every visible consumption race.
Exactly. Before we move on to solutions, we have to address 2 final and deeply ironic areas of self-sabotage. The first is the fear of spending.
The ultimate paradox that afflicts the most diligent accumulators in retirement, decumulation anxiety.
Yes. This is the individual who successfully mastered the saving script for 40 years, built a fortress of wealth, only to be terrified of actually leaving it.
It's a profound identity crisis. For decades, their core identity was tied to their net worth growth. The scorecard must always go up.
And when they enter retirement and start following a safe withdrawal plan, seeing the account balance decline, even if it's mathematically safe, triggers a primal fear of running out of money. It flips their saver script into a destructive hoarder script.
The cost is not financial, but existential. It's the destruction of what we call life capital.
Exactly. They deny themselves the very experiences that the money was saved for in the first place. They forego necessary healthcare procedures, they refuse to travel, they live in constant deprivation despite being millionaires.
And they hoard the wealth until they pass away.
Instead of using strategic gifting when their children are in their 30s and 40s and desperately need the capital for a home or education, the profound irony of decumulation anxiety is that the fear of being poor prevents them from ever being truly rich in lived experience.
Let's finish this section by detailing how the fear response mechanically translates into poor investment decisions, specifically through 3 core cognitive biases, starting with recency bias.
Recency bias is our brain's attempt to predict the future based on the most easily recalled recent information. It's giving excessive weight to recent events.
So if the market crashed violently in the last 2 years,
Then the fear-based conclusion is that volatility and crashes are the new norm, and the market is just too dangerous.
it leads to panic selling at the lows, or conversely, buying into a mania because of the recent hot performance.
It blinds the investor to the long-term historical mean. The fear of experiencing the pain of the recent crash again overrides the mathematical certainty that the market has always recovered and grown over time. It's a short-term emotion preventing a long-term strategy.
A classic example would be exiting the market in 2022 because of inflation fears.
And then missing the significant recovery that followed, driven by the fear that the previous year's pain would continue indefinitely.
Next, confirmation bias. I'm guessing this is driven by the fear of being wrong.
Absolutely, it attacks the ego. Confirmation bias is the selective search for information that validates a pre-existing belief or decision, purely to soothe the anxiety of being mistaken.
So if an investor owns a stock that is clearly failing,
Instead of accepting the small loss, they will only read the positive bullish news about the company.
it's the sunk cost fallacy in disguise. They avoid realizing the loss to protect their identity as a smart investor.
Yeah, and the cost is massive opportunity cost. By refusing to accept that small early loss, driven by the fear of admitting a mistake, they incur the much larger cost of having capital tied up indefinitely in a declining or dead asset.
Preventing that money from being deployed into a healthier, growing investment.
Correct.
And finally, the fear-driven trap of anchoring bias.
Anchoring is fixing your decision, usually your sell decision, to an arbitrary and irrelevant point, most often the price you originally paid for the asset.
The phrase is, I won't sell until it gets back to what I paid for it.
Right. And the fear here is the psychological pain of realizing the loss, which, again, triggers that 2-to-1 pain ratio.
But the market doesn't care what price you paid for it.
It is entirely irrelevant. By refusing to cut that declining asset because of that arbitrary anchor, the investor is anchored to the past, paralyzed by the fear of loss, and incurring a compounded opportunity cost on capital that could be generating significant returns elsewhere. These 3 biases are the technical ways in which emotional fear actively destroys perfectly good financial strategies.
So if you synthesize all of these internal fears, the scarcity mindset, the paralysis of loss aversion, the avoidance response, the cumulative effect is often just inaction.
Yes.
The investor, terrified of making a mistake, makes the ultimate mistake, doing absolutely nothing.
And this is the critical takeaway. In finance, inaction is not passive. It is an active, quantifiable decision with a real cost.
The fear of an unknown potential risk, like volatility, becomes the justification for embracing a known guaranteed loss, like inflation and opportunity cost.
That's it in a nutshell.
We need to use the cost of waiting calculator to truly drive home the exponential decay caused by procrastination driven by fear. This is the most costly silent mistake of all.
Let's use a simple, clear example. An investor who aims to save $500 every month, assuming an average 8% return, compounded until age 65.
Okay.
If this investor overcomes their fear and starts diligently at age 25, they benefit from the full force of compounding, and they accumulate approximately $1.7 million by retirement.
A great outcome. Now, what if that investor delays starting for just 10 years? They wait for the right time or the perfect plan, starting at age 35 instead of 25?
That's a 10-year delay in a 40-year working life.
A quarter of the time.
By age 65, that 10-year delay, which represents only 25% of the total investment period, costs them nearly $1 million.
$1 million.
They will have only accumulated approximately $750,000. That first decade of compounding, which they lost because of inertia and fear, accounted for 60% of their potential final wealth. The fear of starting imperfectly caused them to sacrifice 7 figures of future security. That is the compounding cost of procrastination.
The diagnosis is clear. Internal, silent fear is the primary enemy of wealth. So now, how do we move from being victims of subconscious reaction to masters of conscious, strategic action?
We have to move from this vague anxiety to structured risk management. The first step is to disarm the fear by defining it.
Okay.
And we can use a tool popularized by Tim Ferriss, which actually draws on ancient Stoic philosophy.
Fear setting.
This sounds like turning anxiety into a project plan. How does fear setting neutralize the emotional response?
It works by removing the terror of the unknown. You force yourself to sit down and write down the answers to 4 specific questions. First, you define the absolute worst-case scenario of a decision. Not the unlikely fear, but the concrete worst outcome. For example, losing 20% of my invested capital.
Then what? Second, you list every prevented action you can take now to mitigate that. Diversification, maintaining a 3-year cash reserve, whatever it is. Third, you list repair actions you would take if the worst actually happens. You'd cut discretionary spending, you'd reallocate capital, you'd wait for the recovery.
And the 4th step is the most powerful psychological tool, isn't it?
Crucially, yes. You list the cost of inaction. What is the guaranteed long-term cost of doing nothing? You list the inflation erosion, the compounded opportunity cost of delay, the possibility of having to work 10 years longer.
And when people do this,
When people complete this exercise,
yeah,
they almost always realize that the cost of doing nothing is higher, more certain, and more emotionally devastating than the risks associated with taking a carefully planned action. Defined risk is manageable. Vague anxiety is paralyzing.
so to tackle those personalized, deep-seated issues, those money scripts, we need more than just logic. We need something like therapeutic intervention.
This is where financial therapy and self-reflection become essential. You have to engage in what's called flashpoint analysis.
So, journaling.
Journaling to identify the origin of your specific financial fear. What was your first, most intense memory of money or debt or wealth? Was it the fights, the secrecy, or the sudden loss? Just bringing that subconscious script into your conscious awareness is the first step toward disarming it.
And once you identify the script, how do you go about rewriting it?
Through rescripting. If your inherited script is money is scary and fleeting, from the vigilant script, you consciously create and internalize a new, positive, and accurate mantra. Money is a tool for security and for generating opportunities.
And if your script is money is evil,
From the avoidance script, you replace it with my wealth is a responsibility that allows me to support my family and my community. This conscious, repetitive mental work helps override the emotionally charged programming of childhood trauma.
since we know the amygdala is the enemy of good investment decisions, the single most effective tactical solution is probably to just remove the human emotional element from the equation entirely.
Automation is the ultimate behavior shield. By setting up automated transfers to investment accounts and adopting dollar-cost averaging, or DCA, you eliminate the constant, painful decision to buy or sell
You take yourself out of it.
completely. DCA means you invest a fixed amount regularly, regardless of market sentiment. This neutralizes the fear of bad timing, and crucially, it turns volatility into a mathematical advantage because your fixed dollar amount naturally buys more shares when prices are low. You buy without the panic.
And finally, for those of us paralyzed by the fear of making a mistake, by perfectionism, we need the good enough plan.
Perfectionism is the most common disguise for financial fear. People delay action indefinitely because they are waiting for the perfect stock, the perfect interest rate, or the perfect economic conditions.
Which never arrives.
They never do. The strategy here, often associated with the Boglehead philosophy, is radical simplicity. Accept that a simple, highly diversified, low-cost index fund portfolio executed today is exponentially superior to a complicated, customized, perfect plan that is never executed. Action cures fear. The goal is not perfection. The goal is relentless execution.
We have completed the deep dive. The core thesis stands firm. Financial success is less about mastering complex mathematics and more about mastering your own ancient biology and psychology. The destruction of wealth is silent. It operates in the gap between what we know logically and what our fear screams at us to do: panic, flee, or freeze.
And the antidote is not just more financial literacy, although that certainly helps. You can be an economist and still sell at the bottom because the fear overrides the intellect.
So it's not what you know, it's what you do.
The antidote is financial emotional intelligence. The self-awareness required to identify your specific internal mechanisms of self-sabotage and then implement automated, structured systems that protect you from yourself.
So, as you go back into your week, we challenge you to reflect on your own specific money scripts and biases. Identify where your fear is steering the ship. Are you letting the fear of a loud, perceived threat, a temporary market, dip blind you to the guaranteed silent loss of inflation?
And remember, the goal of wealth is not simply to maximize a number on a balance sheet. The goal is to ensure your money serves your life and your values, rather than allowing your ancient, silent fears to rule your wealth and dictate your future happiness.